Hey, this is Hutch with BankingTruths.com, and today we're going to talk about IUL's viral moment. Right now, NASCAR's Kyle Busch is suing Pacific Life and his life insurance agent after paying over $10 million in a premium into their IUL policies, only to have them lapse well within 10 years. And he and his wife are taking to social media saying that this was just a complete scam. And isn't this what Dave Ramsey, Suze Orman, even infinite banking agents selling whole life, haven't they been saying this all along? But I'll tell you, the devil is in the details, and there's way more to this story than a simple "I told you so." So I not only sell IUL, but I've owned multiple different policies from several different companies over the last 13 years. Some of them haven't worked out. Most of them have. I've seen the good, the bad, and the ugly, and what I can tell you is Kyle Busch's scenario is the ugliest of the ugly. And I don't use IUL to replace my investments. I use it to complement my investments. And so in this video, I'm going to teach you the best practices when it comes to policy selection, design, and implementation. First off, Kyle Busch's lawsuit alleges that both Pac Life and his agents position these policies as investment alternatives. And pundits in the financial media have long been saying, I can get a better rate of return in the market. To which I'd reply, I completely agree with you, but you're wasting your time. You're wasting too much energy trying to answer the wrong question correctly. It's like comparing apples to oranges. I realize a lot of agents out there are selling IUL like an investment alternative, but with IUL, I'm not trying to beat the market. I'm trying to beat the bank. I'm trying to beat bonds. And I don't care how aggressive an investor you are, every one of us needs a certain amount of cash, a certain amount of liquidity on hand besides our investments. Even if you're just investing in dividend stocks or index funds, you still have an emergency fund. If you're a business owner, you have gobs and gobs of cash passing through your hand to buy equipment, inventory, payroll, etc. If you're a real estate investor, you need lots of cash in between projects for a down payment for that acquisition. And even after things are paying off, whether you sell the house or you're collecting rents, you need a receptacle to warehouse that cash. And cash is trash. That's why big banks themselves park billions of dollars of their tier 1 reserves in max funded life insurance policies. They get a better rate of return on cash. They get tax immunity on that return, which actually boosts the real return they're getting. They have 95% liquidity at any time for any reason. And how about this? Their emergency fund will double or triple if one of their key executive dies. Does your emergency fund do that? And arguably, you being the executive for your family, for your business, is way more valuable than one of Bank of America or Wells Fargo's key executives. So that's why our motto is don't do what banks say, do what they do. Now, Kyle Busch alleges he got scammed for $10.9 million. That's how much he paid in premiums. So do you think that the CEO of Bank of America and Wells Fargo are getting scammed for nearly $2 billion each? Or did they perhaps just do a little bit more due diligence than Kyle did rather than take the whole trust me bro approach with his agent? Remember how I said the devil was in the details? Well, Kyle Busch's horrifically designed policies is where the rubber meets the road, so to speak, and not in a good way. It's nearly impossible to lose all your money ever really in a max funded IUL that's properly chosen, designed, funded, and monitored. However, to lose all your money in the first 8 years, a whole confluence of things, bad things, needed to go wrong in order for that to happen. And so we're going to go over each one of them, and it starts with what I said, max funding. If you want to maximize cash value performance in any life insurance policy, especially IUL, you have to minimize the death benefit, which reduces the fees, the charges, and the commissions. Unfortunately, the agent saw a cash grab. The Pac Life wholesalers that represented him also saw a cash grab. And so rather than reduce that death benefit, they didn't have him. They sold him a very big policy, and they had him only not min fund, but they certainly didn't maximum fund. Secondly, Kyle's a NASCAR driver. So there were these extra mortality charges, these extra fees. It's called a flat extra over the first 20 years. And there were a lot of them because race car driving is very dangerous. And so the insurance company has to actually compensate for that. But because there's these extra fees or charges, it's even more important to shrink wrap that death benefit around the cash to get the best possible performance that a NASCAR driver could get. If you're not a race car driver, if you're not a rock climber, if you're not a new private pilot, you're not going to have these extra fees. So third, even if you do shrink wrap the death benefit, there are what are called term riders that are available on almost any kind of life insurance policy, whether it be whole life or IUL. It's a lot more common for people exploring whole life as their own bank to understand that these term riders can give you the death benefit you need in order to max fund, but bring down the cost of that death benefit, which means more of your cash value goes to growth and less goes to, again, fees, charges, commissions, etc. Now, when you use these term riders, there is a bit of a trade-off in terms of long-term sustainability if you're going to keep a lot of death benefit for a long time. But this is a trade-off that should be modeled by his agent with math, not just stories. I don't even think it was even brought up. It usually isn't. And agents realize that if they add these term riders, they're lower. Now, there is a bit of a trade-off in terms of safety and sustainability when using these terms, but that's something his agents should have modeled for him, the cost-benefit analysis, and let Kyle decide. I have a feeling that most of the sales process was trust me, bro, and stories, philosophy, everything else. And we see this a lot because life insurance is a complicated subject. We are very good at taking complex concepts and breaking them down to ways that people can understand, and then showing them that context with the numbers once they understand that concept. Regardless, the whole idea with IUL is that the excess performance of the index crediting strategies are going to more than make up for those charges, assuming you are shrink wrapping the death benefit. But fourth, in the case of Kyle, he was in the fixed account, which is like a bank account for the first few years of the policy. And so on the heels of COVID, he missed out on all those gains to actually capture that excess return, which could go ahead and take care of some of the charges, even if his policy was perfectly designed. And Pac Life actually has a number of very attractive and diverse index options. And that is one of the keys to choosing the right IUL company. So this is not a recommendation by any means. What I am saying though is most agents come with one company. This is my favorite company. And I think what you need to do is you need to explore options out there to find the nice suite of growth options for you. Now, to make matters worse, Kyle's agent actually recommended that he switch from an older policy to a newer policy, which resets all those fees, charges, commissions, etc. And this is a very common ploy, so to speak, in the insurance world, replacement. Now, sometimes there is a viable reason to replace an old insurance policy, but every time you do, you are kind of resetting those fees, paying the freight yet again. And so it's an additional hurdle rate that must be overcome. And again, when clients have atrocious policies like this, there may be a reason to go ahead and do this. But what we do is we actually do an analysis. Like, one thing is just do nothing. What does that look like? That's kind of like with science. You have a control group and an experimental group. Two is you just replace everything. You take the old policy, all the cash value. It's called a 1035 exchange, almost like a 1031 exchange in real estate, and you just roll it into the new policy. And you'll always take a step back, but the idea is that you'll come out ahead after a certain number of time. But you have to look at that with the client and say, is this an acceptable number of years before you start to pull ahead as if you did nothing? And the third option, which most people don't even consider, probably because the agent doesn't make as much commission, is keep the old policy, figure out if there's a way to optimize it, shrink wrap those charges further, and then take the new premiums that you were going to pay into a newer, better performing policy. Now, that assumes you're paying extra premiums, but that was one of the other problems in this case is both Pac Life and the agents claimed that he was going to be fully funded after a few years. In fact, one of the last emails that's in the lawsuit document itself actually said final payment. And that's one of the problems of IUL, especially when it's poorly designed and underfunded, is there really is no technical final payment. Like, you never really know. The actual product, Universal Life, when you look at the contract documents, it says flexible premium adjustable life, which entails that you have a lot of flexibility how to pay. They have adjustability of fees, charges, etc. as you get older. Again, there is a way to go ahead and optimize this, but there's never like a pure guarantee like there is to whole life. The trade-off for not having that ironclad guarantee is you have the index crediting strategies to kind of outperform. And if the policy was done right, we probably wouldn't be having this conversation right now. And that brings me to the last problem, is that with most life insurance sales, it's such a complicated subject that most of the sales process is story-based, rhetoric-based, philosophy-based, very long on words, short on math. And we take a different approach in that we tend to model a lot of scenarios, and illustrations aren't perfect. They are not predicting the future. However, illustrations do give us a way to, again, have that control group, experimental group, and stress test the policy under different factors to see how it's going to perform in good times and bad times, with loans, without loans. And you can really kind of understand where those pressure points are and if this is going to be a good, viable, long-term buffer. Again, cash is trash. For decades, savers have been punished, been debased, and that appears to be continuing to happen with 37 trillion of debt. So a lot of this sale to Kyle Busch was based on the fear of taxes. But it's a very real concern. Like, we just went from 36 trillion of debt to 37 after like a month and change, and it is just snowballing to the upside. They're trying to lower rates to bring down the interest costs of our debt, but by doing so, they're going to bring back inflation, and that is going to hurt savers. But again, by using max funded life insurance not as an investment replacement, but as a savings vehicle like the banks themselves use, you give your risk off liquid assets that we all need to some degree a chance to keep up. So while you're in the accumulation phase, that means building up a bigger cash stack so you can use it to fund your business, you can use it to buy real estate, or you can use it for that emergency / opportunity fund. Since there is a floor that protects you against market risk when stocks are falling, when real estate prices are down, to have a bucket of liquid assets that you can pounce on the opportunity is priceless. When you're in retirement, that means having a buffer account, a pool of liquid capital that you can tap into to avoid those highest tax bracket or keep from having to cash out stocks, mutual funds, your 401k, from having to cash out too many shares when the market's down. Having this little buffer asset that can get you over the hump for 2 or 3 years until the market recovers is going to be invaluable. So even the most aggressive investors who just say, you know what, I'm just going to buy, borrow, die like the billionaires, it's an awesome strategy, but the problem is they don't have billions of dollars of collateral to back millions or hundreds of thousands of loans. Those guys can't get liquidated, but you can if you're playing the dangerous game of buy, borrow, die, and all you have is correlated assets. And so having a non-correlated asset like whole life, or having a less correlated asset like index universal life that isn't designed terribly like Kyle Busch's, can be an invaluable tool. And that's why I designed the 4D banking system, where you complement your other accounts and loan types with properly designed life insurance policies as the ultimate emergency fund, as your buffer asset, as your bond proxy, as your warehouse for risk-off liquid capital. Again, no savings account that I know will let you participate in low double-digit market gains without the threat of market losses. I realize it may not outperform the market, but we're not trying to beat the market. We're trying to beat the bank. No CD that I know will just immediately double or triple if the account holder passes away. And no bank that I know has some kind of special deal with the government that says, you know what, all the interest you earn with us is going to be tax exempt because we do so much for widows and orphans. We're just forgiven. Our account holders are forgiven from tax. But you have to be careful because the devil's in the details. And if you rely too much on stories, on words, on rhetoric like Kyle Busch did, you could end up with a terrible policy that it turns out is just going to be a sinking ship. Now, if on the other hand, you want a team of agents who will help you both model the math and explain all the context behind these columns and numbers, well, that's what we've been doing for well over a decade and a half. You can go back and see our journey on YouTube, or you can go to our site, bankingtruths.com, and there's the biggest library of free articles and videos on IUL that you can find. You can also book yourself a free consult if you have an older policy and you're wondering, hey, is there a way to optimize this or refine it? Or if it does make sense to do some kind of replacement, but actually not just get stories and words, but get the math to help you back that decision. Anyway, hope to talk to you soon.